Look, I need you to pay very close attention to what I'm about to show you, because what's happening in the precious metals market right now is something most people won't see coming until it's too late. And by then, the opportunity will be gone. You know how everyone's been talking about gold hitting new all-time highs, how silver's been quietly climbing. Most people think that's the story. They think we've already seen the move. But what if I told you that everything we've witnessed so far is just the warm-up? What if the real flip, the kind that creates generational wealth or destroys it, is still ahead of us? Here's what nobody's talking about. While retail investors have been sitting on the sidelines, waiting for a pullback that never comes, there's been a massive shift happening behind closed doors. Central banks around the world just bought over 1,000 tons of gold for the third consecutive year. Think about that. 1,000 tons. That's not normal accumulation. That's preparation. And it's not just any central banks. India, Turkey, Poland, countries that understand what's coming are loading up like there's no tomorrow. The World Gold Council just released their full-year data, and the numbers are staggering. But here's the part that should make your hair stand on end. In the fourth quarter alone, central bank buying accelerated to 333 tons. They're not slowing down. They're speeding up. Now you might be thinking, okay, so central banks are buying gold. They always do that. But that's where you'd be wrong. This isn't business as usual. This is a coordinated global movement away from something and towards something else. And if you understand what they're moving away from, you'll understand why the market is about to flip in a way we haven't seen in decades. Let me paint you a picture. Imagine you're at a party and you notice all the smartest people in the room quietly heading toward the exit. They're not making a scene. They're not announcing anything. They're just leaving, one by one. Would you stay, or would you start asking yourself what they know that you don't? That's exactly what's happening in the financial markets right now. The smart money, the institutional players, the sovereign wealth funds, the family offices that have preserved wealth for generations, they're all moving in the same direction. And that direction is toward hard assets, specifically gold and silver. But why now? What's changed? To understand that, we need to look at what's happening beneath the surface of the global economy. Because while the headlines talk about inflation cooling and soft landings, the reality is far more complex and far more dangerous for anyone holding traditional paper assets. The dollar's dominance as the world's reserve currency is being challenged in ways that would have been unthinkable just a few years ago. The BRICS nations aren't just talking about alternatives anymore. They're building them. They're settling trade in their own currencies. They're creating payment systems that bypass the dollar entirely. And every time they do, the demand for dollars decreases just a little bit more. Now, I know what some of you are thinking. The dollar's been the reserve currency for decades. It's not going anywhere. And you're right, it's not going to disappear overnight. But that's not how these transitions happen. They happen slowly, then suddenly. Like a crack in a dam that starts as a trickle and becomes a flood. Think back to every major currency crisis in history. The British pound was the world's reserve currency for over a century. Then it wasn't. The transition didn't happen because of one dramatic event. It happened because of 1,000 small shifts, 1,000 small decisions by countries and institutions to hold less of it and more of something else. And by the time the average person realized what was happening, the wealth transfer was already complete. Here's where it gets interesting. Gold and silver aren't just benefiting from central bank buying. They're benefiting from a perfect storm of supply constraints, industrial demand, and a fundamental shift in how people view money itself. Let me break this down for you, because each piece of this puzzle is critical. On the supply side, we're facing a crisis that most people don't even know exists. Silver production has been declining for years. The easy deposits have been mined. What's left requires more energy, more capital, and more time to extract. Meanwhile, demand is exploding. Solar panels, electric vehicles, 5G infrastructure, all of these technologies require silver. And not just a little bit. We're talking about millions of ounces being consumed every single year in applications where there is no substitute. Think about that for a second. We're using silver faster than we're mining it, and the gap is widening. This isn't speculation. This is basic supply and demand. And when you have declining supply meeting increasing demand, there's only one direction price can go. But here's where it gets even more interesting. The silver market is tiny compared to other commodities. The entire above-ground supply of investment-grade silver is worth less than the market cap of a single large tech company, which means it wouldn't take much capital flowing into silver to move the price dramatically. We're talking about a market that's so small, so tight, that even a modest shift in investor sentiment could trigger a squeeze unlike anything we've seen before. And that brings us to gold. Gold is different from silver in many ways, but right now, it's telling us the same story. When gold makes new all-time highs, while the stock market is also making new highs, that's unusual. Historically, gold and stocks move in opposite directions. Gold is the fear trade. It's what people buy when they're worried about everything else. So when both are rising together, it means something fundamental has changed in how investors view risk. What's changed is trust, or more accurately, the lack of it. People are starting to realize that the financial system we've built over the past 50 years, a system based entirely on faith in paper currencies and government promises, might not be as stable as we thought. And when that realization spreads, when it moves from the early adopters to the mainstream, that's when the real flip happens. Let me tell you a story that illustrates this perfectly. Back in the early 2000s, there was a fund manager who saw the housing bubble forming. He saw the subprime mortgages, the over-leveraged banks, the whole house of cards, and he started positioning his fund to profit from the collapse. But here's the thing. He was early. For years, he looked like an idiot. His investors questioned him. His peers mocked him. The market kept going up, and he kept betting against it. Then 2008 happened, and in a matter of months, everything he predicted came true. The housing market collapsed, the banks failed, the global financial system nearly imploded, and his fund made billions while everyone else lost everything. The lesson? Being early looks the same as being wrong, right up until the moment it doesn't. That's where we are right now with precious metals. The people positioning themselves in gold and silver today might look early. They might look overly cautious. But when the flip happens, and it will happen, they'll be the ones who preserve their wealth while everyone else scrambles to figure out what went wrong. Now, let me address something important because I know some of you are sitting on significant retirement savings and wondering how this applies to you. If you have $100,000 or more in traditional retirement accounts, IRAs, 401ks, that kind of thing, you need to understand that you have options most people don't know about. There's a way to get physical gold into your retirement account without triggering taxes or penalties. I put together a free guide that walks through exactly how this works. It's in the description below. No pressure, but if protecting your retirement is something you're thinking about, it's worth a look. All right, back to what's happening in the market right now, because this is where things get really fascinating. The technical picture for both gold and silver is setting up in a way that suggests we're on the verge of a major breakout. And I'm not talking about a 10 or 20% move. I'm talking about the kind of move that redefines the entire precious metals market for the next decade. Look at the chart patterns. Gold has been consolidating near its highs, building energy like a coiled spring. Every time it dips, buyers step in immediately. That's not normal profit-taking behavior. That's accumulation. Someone, or more accurately, a lot of someones, are using every pullback as an opportunity to add to their positions. And when a market refuses to go down despite every reason it should, that tells you something important about where it's headed next. Silver is even more interesting. It's been lagging gold for years, which is typical in the early stages of a precious metals bull market. Gold leads, silver follows. But when silver starts to catch up, when that gold to silver ratio begins to compress, that's when the real fireworks begin, because silver is more volatile than gold. It's smaller, more speculative, and when it moves fast. We're starting to see the early signs of that catch-up trade now. Silver has been quietly grinding higher, and the technical indicators are all pointing in the same direction. We're talking about a market that could easily double or triple from current levels if the right catalysts align. And those catalysts are lining up right now. Here's what most people miss about precious metals markets. They're not just driven by supply and demand fundamentals. They're driven by sentiment, by fear, by the collective realization that maybe, just maybe, the emperor has no clothes. And once that realization takes hold, once it spreads from the informed minority to the uninformed majority, the price action becomes parabolic. Think back to the last major gold bull market. From 2000 to 2011, gold went from around $250 an ounce to over $1,900. That's more than a seven-fold increase. And it wasn't a straight line. There were pullbacks, corrections, moments where it looked like the rally was over. But the underlying trend was unmistakable, and the people who stayed positioned through the volatility made life-changing returns. Now, I'm not saying we're going to see the exact same pattern repeat. Markets never repeat exactly, but they do rhyme. And the setup we're seeing today has a lot of similarities to what we saw back then. Massive government spending, currency debasement, geopolitical instability, loss of confidence in traditional financial institutions. All the ingredients are there. But here's the critical difference. Back then, most people didn't understand what was happening until it was halfway over. Today, there's more awareness. More people understand the risks in the system. More people are looking for alternatives, which means when the move happens, it could be faster and more violent than anything we saw before. Let me give you another historical parallel that's even more relevant. In 1971, President Nixon closed the gold window, effectively ending the dollar's convertibility to gold. At the time, gold was $35 an ounce. Most people thought that was the end of the story. The dollar was free-floating now, backed by nothing but faith in the U.S. government. And for a while, nothing happened. Gold drifted higher, but it wasn't dramatic. Then the 1970s happened. Inflation exploded. The dollar lost purchasing power at a rate that shocked everyone. And gold? Gold went from $35 to over $800 by 1980. That's a 23-fold increase in less than a decade. People who positioned themselves early in that trend didn't just preserve their wealth, they multiplied it many times over. The people who waited, who thought they had time, who believed the government when they said inflation was transitory, those people watched their savings evaporate. Their purchasing power disappeared. And by the time they realized what was happening and tried to get into gold, the easy gains were already gone. Are we in a similar moment now? I think the evidence suggests we are. The parallels are striking. We have a currency that's backed by nothing but confidence. We have government spending that's completely out of control. We have debt levels that are mathematically impossible to repay. And we have central banks around the world quietly preparing for what comes next by accumulating gold at a pace we haven't seen in modern history. But here's what makes this moment even more critical. Back in the 70s, the financial system was simpler. There were fewer derivatives, fewer interconnections, fewer ways for problems in one part of the system to cascade into others. Today, the financial system is so complex, so interconnected, that a crisis in one area can spread globally in a matter of hours. We saw that in 2008. We saw it again in 2020 when the pandemic hit. And we'll see it again when the next crisis emerges. And make no mistake, there will be a next crisis. Not because I'm pessimistic, but because that's how the system is designed. It's built on debt, on leverage, on the assumption that growth will continue forever and that problems can always be solved by printing more money. But there's a limit to how long that can work, and we're approaching that limit faster than most people realize. The bond market is starting to show cracks. Yields are moving in ways that suggest investors are losing confidence in government debt. The stock market is trading at valuations that only make sense if you believe earnings will grow forever and interest rates will stay low indefinitely. The real estate market in many areas is pricing in assumptions that look increasingly unrealistic. Everywhere you look, there are signs of excess, of speculation, of a system that's stretched to its breaking point. And when that breaking point comes, when the market flips from risk on to risk off, from confidence to fear, where do you think capital is going to flow? It's going to flow to the assets that have preserved wealth for thousands of years. Gold and silver, the only forms of money that can't be printed, that can't be debased, that can't be manipulated by central banks or governments. Now, I want to be clear about something. I'm not saying the sky is falling tomorrow. I'm not saying you should panic or make rash decisions. What I am saying is that the setup we're seeing right now is rare. It's the kind of setup that comes along maybe once or twice in a generation. And the people who recognize it early, who position themselves before the crowd figures it out, are the ones who benefit the most. Think about the mechanics of what happens when a market flips. In the early stages, it's just the smart money moving. The institutions, the hedge funds, the people with access to information and resources that retail investors don't have. They start accumulating quietly, without making noise, without driving the price up too fast. This phase can last months or even years. Then something changes. Maybe it's a geopolitical event. Maybe it's an economic data point that can't be ignored. Maybe it's just the slow accumulation of evidence that reaches a critical mass. Whatever it is, sentiment shifts. And when sentiment shifts in markets, it happens fast. Suddenly everyone wants in. Retail investors who were sitting on the sidelines start buying. Financial advisors who were skeptical start recommending allocation. Media outlets that ignored the story start covering it. And the price? The price goes parabolic. Because now you have a flood of capital chasing a limited supply of assets. And in markets like gold and silver, where the physical supply is constrained, that creates explosive moves. We saw this in 2011 when gold hit its previous all-time high. We saw it in silver when it briefly touched $50 an ounce. And we'll see it again. The only question is whether you'll be positioned before it happens, or whether you'll be one of the people chasing the move after it's already underway. Here's another angle most people aren't considering. The paper markets for gold and silver, the futures contracts, the ETFs, the various financial instruments that claim to represent physical metal, are massively larger than the actual physical supply. Some estimates suggest there are 100 ounces of paper claims for every ounce of physical metal, maybe more. Now, as long as everyone's content to trade paper, that system works fine. But what happens when people start demanding physical delivery? What happens when investors lose confidence in the paper promises and want the real thing? That's when you get a squeeze. That's when the price of physical metal decouples from the paper price. And that's when the people holding physical metal see gains that dwarf anything happening in the paper markets. There are already signs this is starting to happen. Premiums on physical gold and silver coins have been elevated for months. Delivery times from major dealers have been stretching out. Central banks are repatriating their gold, bringing it home from foreign vaults. These are all signals that the smart money is moving from paper to physical. And when that trend accelerates, and it will accelerate, the market dynamics change completely. Let me give you a specific example of how this could play out. Imagine you're a large institutional investor with significant exposure to paper gold through ETFs or futures contracts. You've been comfortable with that exposure because it's liquid, it's easy to trade, and it tracks the gold price reasonably well. But then you start hearing stories about delivery problems. You start seeing premiums on physical metal widening. You start wondering whether your paper claims are really as good as physical metal. So you decide to convert some of your paper position to physical. But you're not the only one thinking this way. Hundreds or thousands of other investors are having the same realization at the same time, and suddenly there's a rush for physical metal. The dealers can't keep up with demand. The premiums explode, and the price of physical gold starts trading at a significant premium to the paper price. That's the flip. That's the moment when the market structure changes, fundamentally. And once it happens, there's no going back. Because once investors lose confidence in paper claims, once they realize that physical metal is the only thing that matters, the entire pricing mechanism breaks down. We're not there yet. But we're closer than most people think. And the warning signs are everywhere if you know where to look. The central bank buying, the supply constraints, the geopolitical tensions, the currency debasement, the loss of confidence in traditional institutions. All of these factors are converging at the same time, creating a perfect storm for precious metals. And here's the thing about perfect storms. They don't announce themselves with a press release. They build quietly, beneath the surface, until suddenly they're upon you. And by then, it's too late to prepare. You're either positioned or you're not. So what does positioning yourself look like? It means having a meaningful allocation to physical gold and silver, not just a token amount, not just a few coins tucked away in a drawer, but a real position that can make a difference in your overall wealth when the market flips. It means understanding the difference between paper and physical. It means being willing to hold through volatility, through the inevitable pullbacks and corrections that will test your conviction. It also means being patient. Because while I believe the setup is in place for a major move, I can't tell you exactly when it will happen. Markets don't work on our timeline. They work on their own timeline. But what I can tell you is that the longer you wait, the more risk you take that you'll miss the early stages of the move. And the early stages are where the biggest gains are made. Think about it this way. If you buy gold at $2,000 an ounce and it goes to $4,000, you've doubled your money. That's a great return. But if you buy at $1,500 and it goes to $4,000, you've more than doubled your money. The difference between being early and being late can be the difference between a good return and a life-changing return. And that's really what this is about. Not just making money, but preserving and growing wealth in an environment where traditional strategies might not work. Where holding cash means watching your purchasing power erode. Where stocks and bonds might not provide the returns they have in the past. Where the rules of the game are changing in ways that favor hard assets over paper promises. The market is about to flip. The evidence is overwhelming. The question is whether you'll be on the right side of that flip or the wrong side. Whether you'll be one of the people who saw it coming and positioned accordingly, or one of the people who realized too late what was happening. I can't make that decision for you. But I can tell you this. The opportunity is here, right now, before the crowd figures it out, before the headlines start screaming about gold and silver, before your neighbor and your coworker and everyone else starts talking about precious metals. That's when the easy money is made. That's when positioning yourself pays off the most. So take a hard look at your portfolio. Take a hard look at the evidence I've laid out here, and ask yourself, am I prepared for what's coming? Because ready or not, the market is about to flip. And when it does, there won't be time to catch up.